regardless of the numbers. If they were hotter or colder than expected, I expected gold to go up. Because if there was less inflation than expected, well, the programs are set to buy gold on that, right? That's what they think is good for gold, because lower inflation means the Fed cuts sooner. But if there was higher inflation, I knew that gold would sell off initially because that's what the programs are designed to do. But I knew the real money would come in and buy it because gold's an inflation hedge. And again, hotter than expected inflation does not mean the Fed just has to fight a little harder to win. It means the Fed has already lost. Inflation won. The fight is over, and you buy gold.
Gold prices enjoyed a period of relative stability throughout the week, hovering between $2,300 and $2,360 per ounce. However, the calm was shattered late on Thursday when they suddenly skyrocketed to a new all-time high, surpassing $2,400 per ounce. This abrupt surge was prompted by alarming reports suggesting potential Iranian attacks on Israeli targets, sparking renewed volatility in the market. PeterSchiff, a prominent American stockbroker, underscores the value of gold and silver as safeguards against inflation, noting their tendency to move inversely to fiat currencies. Despite occasional short-term fluctuations driven by inflation data, a growing sentiment of waning confidence in central bank strategies aimed at effectively managing inflation exists. Since October of the previous year, gold has embarked on an impressive upward trajectory, consistently setting new all-time highs and boasting a remarkable gain of over 21% since mid-February. Peter underscores that this persistent inflationary pressure challenges the prevailing narrative regarding central banks' efficacy in maintaining inflation within target ranges, potentially necessitating a re-evaluation of monetary policies and fostering increased investment in precious metals. The recent surge in gold prices contradicted expectations of the Federal Reserve's imminent interest rate reduction. Despite a more moderate uptick in the U.S. Producer Price Index observed on Thursday, following the release of robust March Consumer Price Index data, traders remained wary, signaling ongoing uncertainty within the market. Come along as we explore the valuable insights provided by PeterSchiff. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
The smart money is buying gold and silver. The central banks, the foreign central banks. Gold has been moving from west to east. So we sell, they buy. And so I believe there's going to be buying coming in to the gold and silver market. Maybe there'll be an initial sell-off on the follow-through with what we did. But I expect big buyers to come in, as they have been over the past several months. The sellers are here. Why? Because Americans are dumb. They're selling their real gold to buy fool's gold, Bitcoin ETFs. The West, or the East rather, is taking advantage of our greed and ignorance, and they're buying real gold as much as they can get their hands on, because this is a significant event. This is the beginning of the end of dollar hegemony, the U.S. dominance of the global economy. The dollar's days as the world reserve currency are numbered. Foreign central banks don't want dollars. They don't want treasuries, even if we pay them 5% to hold them, because they know that that's still a losing proposition, because inflation is going to be higher than that. People are just buying gold as a hedge. I mean, in a way, they're right. It is a hedge, but it's not a hedge against geopolitical uncertainty. It's a hedge against inflation. That's what everybody is hedging. That's what central banks are hedging. They're hedging their dollar reserves. In fact, they're getting out of their dollar reserves. They're also lightening up on euros and pounds and yen. Part of what's masking this problem is the relative strength in the dollar. And I say relative because the dollar is actually weak. Gold tells you what's actually happening. Gold today hit a new all-time record high in every single currency. Now, relative to other currencies, the dollar index was up today. But that doesn't mean the dollar was up. Gold tells you the dollar was down. What the rising dollar index tells you in an environment of a rising gold price is that the dollar is losing value. It's just losing less value than the euro, or losing its value more slowly than the euro or the pound or the yen. That's what's happening, regardless of the numbers. If they were hotter or colder than expected, I expected gold to go up. Because if there was less inflation than expected, well, the programs are set to buy gold on that, right? That's what they think is good for gold, because lower inflation means the Fed cuts sooner. But if there was higher inflation, I knew that gold would sell off initially because that's what the programs are designed to do. But I knew the real money would come in and buy it because gold's an inflation hedge. And again, hotter than expected inflation does not mean the Fed just has to fight a little harder to win. It means the Fed has already lost. Inflation won. The fight is over, and you buy gold. And so what happened? So on Wednesday, we got the CPI. And the expectation was for a 0.3% rise, which, if you annualize that, is still well north of the 2% target that the Fed claims we're on a glide path to hit. The prior month was 0.4. So we ended up getting 0.4 again. So ahead of the 0.2% that people were expecting. But if you figure we've got 0.4 2 months in a row for CPI, well, what if you annualize that? You know, we got it 2 months, so annualize it 6 more times. That's 5% inflation. 5 seems like it's a lot higher than 2. And if you're at 5 right now and you're trending up, right, because we bottomed out lower, we've been trending higher in inflation for, I don't know, 6 months, 8 months. I forget. We bottomed out around 3.1 year over year. The year over year now is 3.5 and the year over year core is 3.8. So we never actually got even close to 2. And now we're headed back up. So based on that data, how does the Fed conclude that we're likely headed down to 2 and that they can start cutting rates?
March saw a surge in gas prices and a notable increase in mortgages and rent, driving inflation up beyond expectations and exacerbating the financial strain faced by Americans. This upward trend in inflation may compel the Federal Reserve to maintain its current high interest rates for a prolonged period. According to the latest data from the Bureau of Labor Statistics released on Wednesday, U.S. consumer prices climbed by 3.5% over the 12 months leading up to March. This cost spike reflects the ongoing challenges many Americans are grappling with due to rising expenses. Peter contends that official inflation figures only reflect part of the extent of inflationary pressures. He believes inflation is mainly driven by increased money supply, credit expansion, heightened borrowing and spending, and a decline in manufacturing output. In contrast, the Producer Price Index data released by the Labor Department's Bureau of Labor Statistics on Thursday showed a more modest increase of 0.2% for the month, falling short of the 0.3% estimate projected by the Dow Jones Consensus and below February's 0.6% rise. Peter highlights disparities between the reported PPI figures and the actual surge in energy prices. Despite attempts by the government to adjust for seasonal fluctuations, the underlying inflationary trend remains intact, indicating a broader challenge in accurately assessing inflationary pressures. Let's get back to the interview.
Since we know inflation is an expansion of the money supply and the credit, if credit is blowing out, if everybody is borrowing money and spending it, why would you think that inflation is going to come down? All that spending bids prices higher. And also manufacturing is in a recession. So we're producing less and we're spending more. I mean, what does that mean? Less supply, more demand, higher prices, right? It's obvious. All of the data. Powell says the Fed is data dependent, waiting for a cut. But if it actually paid attention to the data, it would be hiking. That is the point. Now, of course, the markets, when they see this number, oh my God, we may have to wait a couple more months to get that rate cut. Does it dawn on them that the rate cut's a mistake, that we need to hike rates? That's why I said it doesn't matter to gold. It doesn't matter when the Fed cuts rates, if they ever cut rates. Gold's going up because real rates are falling, because inflation is rising as the Fed is standing pat. And so even though gold sold off $20 or so on that news, it rallied back like $40, $50 the next day. So all of the decline was recovered. Now, of course, the media might say, well, that's because the PPI came out and it wasn't as bad as expected because they were looking for up 0.3 and it came out at up 0.2. And the year over year was supposed to be up 2.3, but it was only up 2.1. And so they think, oh, you see, that balanced it out, which, first of all, it doesn't balance it out. But Zero Hedge did a good job of pointing it out. And I retweeted something that they put up. So the big reason that the PPI was lower than expected, it was still up. But the big reason it was lower than expected was because the government claimed that energy prices were down 3.6%. So it was this big drop in energy prices that caused the PPI to go up less than expected. Except the problem was energy prices didn't drop. They went up 6.3%. So producers actually paid 6.3% more in February, right, than they did in March, rather. Producers paid 6.3% more for their energy in March than they did in February. But the government pretended that they got that energy for 3.6% cheaper. And because of that pretend reduction in the price of oil, they were able to pretend that producer prices rose less than they actually did. Now, well, how do they do that? Well, apparently it's a seasonal adjustment. Well, who cares? I mean, the price went up. What difference does the season make? It's like, you go to a store, a restaurant or something, and the restaurant owner really raises your prices and you're paying, let's say it's 10%, 20% more than you remember. And you complain and say, well, why did you raise my price? Well, I didn't really raise your price. I actually cut your price when you seasonally adjust it because you're eating at the restaurant at a time. See, I normally raise my prices even more than this. And because I raise it a little less, well, you actually got a price cut. So be happy, right? I mean, this is all a farce. Prices went up and they want to pretend that they went down, right? So, but again, the real market knows that this doesn't matter. All this is noise, right? These government numbers don't even tell the whole story anyway. It's all rigged. Not like that they don't fake the numbers. The numbers are the numbers. They rig the indexes. The indexes don't accurately measure inflation.
Given the ongoing challenges posed by inflation and market uncertainty, what steps can individuals and businesses take to navigate these turbulent economic times effectively? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.